Live. Welcome,
GM.
welcome, GM.
GM,
Today
everyone.
is
Hello.
April 24th at approximately 2:15 Eastern Standard, 6:16 UTC. We have with us today DK, our own in-house TradFi boomer, Tolga, Little Trench Warrior, JC Denton.
GM.
And let me pull this up.
What are we going through today, guys?
Today we come to you bearing gifts.
Ooh.
You're always hearing soon. We get a lot of whens, when this, when that. So today we will be taking some time to go over combo trades in the new strategy builder that will be available on Kyan.
Nice. When's Kyan going live?
This summer.
Winston.
Soon, very soon. Now, I think for some people who might not have joined on the previous call, I think the previous call was on portfolio margin, right, guys? I think that was sort of the full-fledged display of what is the portfolio margin system we're going to implement. What are the pros and cons around portfolio margin? Well, mostly pros. There's not really any cons. But this, I think, is sort of like the next step, kind of like the building blocks of our system, right? Portfolio margin being sort of the bedrock of the whole system. And then now one of the things that you can actually do, obviously combo trades and using the strategy builder are basically things that you can do in our system because of the portfolio margin risk implementation or risk model that we are implementing. So if you haven't seen that, I would highly suggest looking at that as well. I'm not sure, Cozy, if there's like a link to the previous call. We can maybe like give to people so they can see that as well.
Yeah, let me find that. And then what I can do is I will link
give
that.
that a
Maybe
retweet.
Denton as
We'll give
our
that a retweet.
There
our
we go.
social media savant. Maybe you can quote tweet our previous presentation on X or include it in the comments.
And if you guys aren't at the point to be able to watch the whole thing, essentially, the very oversimplified summary is that we have a full service portfolio margin system. It's something similar that you would see at a place like Deribit. So from a capital efficiency standpoint, from a modeling standpoint, from just general functionality, a lot of it mirrors that similar architecture that Deribit has, that a lot of people are used to and they like. Generally, risk models are pretty vanilla. There's not really room for creativity. There's basic features that you can create around portfolio margin. But obviously, Deribit being sort of the best in class in terms of their system design and their capital efficiency, we've adopted a lot of functionality and components from them that sort of make that transition from, say, a SEX to a DEX, well, I guess less friction, right? The knowledge base, if you've used Deribit before, is going to be significantly smaller with our system, and you're going to see that with combo trades as well. There's a very similar look and feel that's going to be the same. It's a very standardized process, right? But it's easy to kind of like show. It's a little harder to kind of design and implement, but we wanted to make sure we had all the features, and we're going to highlight those today for you guys. Let's get started.
Let's go.
Get into it.
Yeah.
Boom. Okay. Kyan Exchange. So what Kyan Premia V4 is all about? Options and perpetual futures. Permissionless and transparent. I almost said permissionlessness. That would have been a tongue twister. Portfolio margin, as Tolga just touched on, and multi-leg strategies, combo trades. And that is what we will be focusing on today. So I'll pass it over to you. Let's get into portfolio margin. We talked a bit about it. Maybe you want to just give a brief overview on our portfolio margin system, the implementation we're using, and kind of how that's different from some of the existing portfolio margins in DeFi, the existing portfolio margin systems in DeFi. Because although there are some that exist, ours will kind of be the first of its kind in its own realm.
Yeah, I think the term margin is used quite a lot, and I'm not sure that sometimes words can be misused. Sometimes they can be relatively vague on purpose, and certain exchanges can say that they have margin, but knowing what type of margin it is and what capabilities that margin system has is not always clear. So, a full service portfolio margin system in DeFi is relatively rare. I'm not sure there's many people doing it, if any. To be honest with you, I think they have different forms or different flavors of margin for sure. That definitely exists, but usually the devil's in the details, right? And when you start to use a platform and you start to use their margin system, you start to slowly kind of realize maybe some limitations or gotchas that sort of don't stick out immediately, based on sort of the attention grabbing headlines that they try to tweet, or things that they write on presentations like this, right? Perfect example. It's very hard to kind of know those details, but sort of, we like to emphasize this on this calls because there's a lot of details that we don't sort of bring up in these calls, mainly for time reasons and just for digestibility. But our margin system is a full service margin system, portfolio margin system. And that allows kind of a lot of different ways to explore and express options and how you would trade options. Volatility being sort of the more advanced sort of component that you can trade, right, for options. Combo trades are probably the more intermediate step, which most people, it's a little bit more digestible if you know basic calls and puts and how they work. Combo trades is sort of like the next progression in your your arsenal of different ways to sort of express opinions on the market movements and direction. And then obviously natural hedging reasons. So portfolio margin offers a lot of flexibility in terms of like how you hedge your positions. And that when you hedge your positions, it also sort of is it's very similar to combo trades, because combo trades themselves also have offsetting positions, which create, sort of new risk profiles. And those naturally hedged positions or combo trades that you do essentially funnel into the margin system and allow that capital efficiency, right? And because we have the portfolio margin as sort of that base layer, building combos or multi-leg trades or doing hedging can be done in piecewise or all at once. And the system won't discriminate you in that process. And so a lot of things you might see, systems that might say have isolated margin that offer combo trades, you're likely to have experienced less freedom or functionality to be able to sort of do combo trades, whether it's a limited amount of legs that you could add to the combo trade. So maybe like a max of 2 instead of like 3 or 4. Maybe the way that you get in and out of these combo trades. So like a simple example would be like a call spread. Call spread has 2 different legs to it. And so some systems won't allow you to trade both legs individually. You have to trade them at once when you get in to your trade and once when you get out, both at the same time, atomically. And while sometimes that can be helpful, other times it can be really restrictive in how you build your combo trades. Maybe you want to leg into it. Maybe you want to have one position and you have a change of opinion now all of a sudden of where the market is, and you want to like hedge that option. You don't want to completely get rid of it. I'll bring up some examples later on the call, sort of a little bit more specific around, say, like a call spread, to kind of show the evolution of how and flexibility of sort of how you can build combo trades, how you can leg in, how you can leg out, where your opinions might change, and sort of how our system will adjust essentially based on your composite portfolio to sort of get you into those positions that you want and make it capital efficient. I think that's all I got for this one. That's probably a lot there. I'm just getting
So-
warmed up though.
So basically, the portfolio margin allows for this system of combo trades where you build all kinds
Yeah.
of strategies with this.
I mean, that's
inbuilt
the
strategy
key.
builder.
Yeah.
Yeah.
Yeah. There's, you know, a lot of people, if you've traded options on dexes, one experience, you know, as I mentioned, was that they would say that they have combos or they would just be basic call spreads. And you would find that these call spreads had actually their own market to them. They had their own bid and ask, and they were not actually two legs of two different markets. They were just a whole different market in
Whole
itself.
bundle. Yeah.
A whole bundle, yeah. And so this is a
Mhm.
problem in a lot of ways. One, it fragments liquidity, because now market makers have to make for 3 different products, not 2, right? Each leg plus the actual like combo itself. And a lot of platforms, because they had to predefine these combos, the amount of call spreads that you had to pick from were predefined. You couldn't even create your own, right? And so that becomes another problem. And so that lack of flexibility is a big issue, right, with isolated margin systems. And this is sort of that freedom that you get with portfolio margin, that one step up that we keep referencing on this call is just that flexibility. So in our system, well, I guess we can maybe start with, basic some combo trades, right?
Yeah, let's start with the basics. What
Highest
are
level.
Yeah, you guys, you take it over.
Okay,
put a
I'll
little
give you the
data
high.
there.
I'll give you the highest level. All right. A combo trade allows you to open a position that has multiple legs atomically. And when I say atomically, that means that all legs will get open or closed, depending on how it is, at the exact same time, meaning your impact to your margin and collateral is also atomic, right? And so if you were to gradually open up a position and you had to do every leg individually, your capital efficiency kind of goes down because maybe the first leg you have to deposit a ton of collateral and then you're selling an offset on your delta there, and then your collateral requirement comes all the way back down, right? And so by opening multiple legs at the same time, we can then get that collateral requirement down, and then you all kind of know that, okay, this is exactly the position that I wanted to get. We have the ability for you to obviously offset with perpetual products as well, which is very capital efficient. And then the last item was lost on me. And then your ability to then come out of that position is the same. So you can, well, let me rephrase that. You have options, no pun, to get out of that position, right? And so you can choose to go as a bundle and sell the entire bundle as one, as essentially selling your entire portfolio or entire position in that regard. Or you can choose to slowly leg out, right? Or in a lot of instances, let's say that you've realized some profit and you want to kind of reduce your exposure, right? And you want to kind of, to stamp some of those gains, right? And so you can do that by instead of selling the entire position, you can start to leg out of certain portions of it.
Now, there's kind of like 2 parts here that there'll be a theme. Like we talk about like both this ability to do atomic trades if you want, and this ability to legging. And so just so we don't confuse you, those are just 2 different options or directions that a user can take in our system in terms of how they want to establish that position. So we have like these little tabs that you see here, these little boxes with these like predefined names. These are in the strategy builder, essentially, where if you know exactly what you want, and you're starting from 0, and I want a call spread, I want the call spread right now, you can build that combo. And so as DK was alluding, that is an atomic trade in our system using the combo builder or the strategy builder, right? We can express those atomically. Now, what that means in the back end is the orders go to both legs. So let's just say in this example, it's a call spread. The order gets routed to both order books of the two calls, right? And the order design is essentially in an atomic state. And so both orders have to fill or neither of them fill, right? And so that allows us in the back end to be able to ensure that if I want this call spread and I want it now, I can get that call spread. Or if you want the flexibility, you can manually go in and out of like the different trades. And so keep in mind that there's sort of those both options in our system. we will be kind of bouncing back and forth between these two different options. And so just want to make sure everyone's sort of aware of that flexibility that you have. But there you can see the predefined butterflies, straddles, strangles, condors. These might be familiar names to you, maybe not. These are some of the most common different strategies or multi-leg strategies that people would implement based on different views. Each of them has like sort of their own bias in terms of why you would do that trade and why it's best for the given bias that you have.
Now, why perps, Tolga? There, a plethora of different Delta One products that could be used. On Kyan, we chose to use perps. Why was that?
It's a good point. Perps obviously are just super popular, right? There's no denying how liquid perps generally are on exchanges. They've been you can adapt, exchanges can adapt to them and generate liquidity in a much easier fashion with perps than futures. So usually with futures, you have different expirations. And so just immediately from there, you can realize that if there are different expirations for futures, this creates a little bit of a liquidity issue. And so liquidity is sort of the primary reason why perps are the more desired product to use. By having a concentration of our market makers on only one market for a specific underlying, right? It just creates a deeper book. And having those deeper books allows you to trade in and out of positions more efficiently. In this particular case, you see it on the screen here. This would be relative to say covered calls or like say protective puts. So if you wanted to establish a position, which was a combination of a perpetual contract and a call option or a put option, you can do that in our system atomically, which is really cool. Yeah, full flexibility. Perps are going to be obviously they're tried and true, tested DeFi products, and even sex products. So like perps all the way, right?
The question that came in was, I answered the first part of it for them, but they said, are we partnering with any perp exchanges or will they be in-house? And I said they'd be in-house. They're wondering why we chose in-house rather than partnering with an already established perps exchange.
Yeah, great question. Well, that question goes to the underpinnings of portfolio margin, right? And so when you do portfolio margin and you want to make sure that you net the risk that a user has on your system, you can only do it if the perpetual product itself is in-house. Portfolio margin doesn't really work with cross exchanges, right? So like if I own a perpetual position on exchange X and I own a position on Kyan in an option, they're not really, even though you are hedged, right? As a user or as a DeFi user, both exchanges don't know what position you have on the other exchange. And so I can't offset the risk, or we can't offset the risk, right? With that perpetual position that you have on exchange X, we don't even know that it exists. And you telling us that it exists doesn't tell us much. We don't know the risk model that they're using, so it's not similar to us. And so there's a bunch of compatibility issues here with using other exchanges. So essentially what we did is we, again, back to the question or back to the point of why perps are very easy to find liquidity for. And so the market makers that we have are ones who are very active on the top dexes and sexes trading perps. So there's no concern for liquidity on perpetual contracts when you build them in-house. And so because of that, not only is building in-house easier for the margin system, it's how you can benefit from it. Liquidity is not a problem doing it on our own. And so that was why we sort of went that direction.
Great explanation.
And to summarize the last point, this combo trade system would allow for more legs than any DeFi competitor, and also hedging with perps on the same portfolio, I think, is not something that's available on other DeFi products.
Yeah. Yeah,
I mean, it's
there's
not
a
like we
whole
didn't look
plethora
at
of
it.
positions.
We gave it the good old college try, right? It's something that we worked on for going up into the V3 launch, the post the V3 launch. We've discussed it with many people, and it's not really feasible. There's too many moving parts, and there's too many aspects of control that neither party wants to kind of give up to make it work, right? And so
You're referring to the using another or
correct,
partnering with
correct,
a third party.
correct.
Yeah.
So we've looked at it for quite a bit, and essentially giving another team access to your collateral calculation is opening up a lot of risk for any protocol. And so that's typically where we would stop, right? Is that, okay, we can't do this because we essentially need to have right access to the collateral calculations of each other, right? And that's typically a risk that no one really wants to take on. We've looked at various different ways that this can be can kind of be improved upon in the future of having like a standard calculation, if you will, or like a standard product type of product format. And we've had those conversations. None of us have really made the move on it, but it is something that we'll be continuing to look at as we go live.
We got a question in the chat. Does portfolio margin let you do delta neutral funding trades on perps without liquidation risk?
Sure. Yeah. Well, let me rephrase that. Delta neutral funding trades. So that's a bit of a vague term. You can sort of extract, if by funding you mean by longing the underlying and shorting the perp, that's sort of would be one strategy. That is currently not available because our base or our collateral token right now is USDC. And so we do not have currently the use case or the use of cross collateral. So like you cannot bring ETH onto our exchange and then trade ETH. So these are not inverse options. These are linear options. And so everything is in USDC. Now that's actually a difference between Deribit and us. But I think generally it's a little bit easier to conceptualize risk and understand how options work when everything is done in USDC. And so we kind of elected to go with that as sort of the first step of the portfolio margin evolution. But cross collateral is something we have looked at and is on the list of things that we want to add. And so once we do that, you will then be able to do funding trades, right? So the collateral underlying ETH, you're holding that, you're short perps, delta neutral, and then you can extract funding and do funding strategies like that. Other ways you can extract funding, if you wanted to, is to explore synthetic option exposures. So, for example, you could do a synthetic long position in options. So you'd be long a call and short a put of the same strike and expiration. And then that gives you a certain delta exposure. And that synthetic long can be matched with a perpetual short. And so by doing that together, if the options don't have the same embedded funding cost or interest rate input, then essentially what you're doing there is you're extracting out the funding rate in the same manner you would as if you were holding the underlying product. So there's a lot of different creative ways in portfolio margin systems that you can do this through options. A synthetic long or synthetic short exposure will get you that sort of pseudo underlying exposure that you wanted, and then you can do the hedge with the perp. And so the very long-winded answer is not in a direct way. We don't take ETH as collateral or BTC, but yes, in an indirect way, you can do it through options, and our risk model adjusts for that, and you can do that with very high leverage.
Good question, you took. So on to the next thing. So we've talked about the strategy builder, but we will also have pre-built strategies available on Kyan. So let's go through that a bit, because I know for some people, trading options in itself may be a newer tool that they've put in their tool belt. So they're familiar with the DEX offerings, but they haven't gone over to Greeks Live, to Paradigm, to Deribit, and played around with the builder before. So let's talk about the pre-built strategies we'll have for users and kind of how that will work.
Sure. So obviously on the previous tab, you saw like all the like the pre-built strategies that you have. So when you click on one of those, essentially what it will do, it will pre-populate a market for you, and you can now start toggling and adjusting it. So I believe on the screen right there, that's an actual example of a butterfly. So you know, once those legs are sort of pre-populated for you, you now have the full flexibility of changing what are the strikes that you want, what is the ratio of the legs that you want, and you sort of get that full flexibility there. So I mentioned earlier, right, there's each one of these like predefined, these very popular predefined strategies have different inherent biases of why you would want to do them. Some have directional components to them. Some are more time-based, and some are more pure volatility-based. So obviously simple examples of straddles and strangles, I'm sure those are terms people have heard before. Those are more volatility plays. Directional plays are, you know, the bread and butter typically tend to be call spreads and put spreads, and time-based calendar spreads, right? And so having the ability to put on calendar spreads with options from different expirations, and having the risk of that even be offset in portfolio margin is super helpful. Many systems don't offer time-based strategies or sort of like calendar spreads because of the complexities that are involved with trading different expirations. This is why a lot of systems typically tend to restrict you to vertical spreads like calls and put spreads, and maybe even straddles and strangles. But in our system, we have a little bit more flexibility for you. And so you can sort of express those as well. And again, these are very common textbook style strategies. You could probably Google them or ask AI, and they can give you a very detailed explanation of, you know, hey, my opinion of the market is this. What would be the best combo trade that I could do? And I'm sure you'll pump out a bunch of strategies for you. And they will most likely form fit some of these more boilerplate strategies for call spreads, time spreads, things like that. And then you'll be off to the races. And
if I could ask,
nice.
if I could ask from a beginner's perspective, let's say I'm used to trading perps, and I'm looking to increase the potential, the efficiency of my trading. Is there a simple, which one of these would be like a simple strategy that I could apply in a certain case where perps wouldn't be enough? Could you give an example?
Yeah, so like, you know, perps are an interesting place, and so there can be, so we can break this down into a couple of biases. One might be like directional, and the other will be time. So let's say that the market's like ripping, right? And your general opinion is that the market's going to continue going up. But if you go over to perps, you'll see that the funding's at 25%. Or maybe 30%, right? Or one of your favorite perp dexes. And that's usually pretty common for when the market's ripping. And your opinion is like, well, you know what? I think this market's going to keep going. But I think there's going to be a consolidation period of, say, 2 to 3 weeks. I'm not sure I want to hold something that's charging me 30% annualized for 3 weeks. I also don't like the fact that if I get into a highly leveraged position with perps, that I could get liquidated. And the liquidation risk is something as well that I don't want to sort of be directly involved with. So in that particular instance, you might want to do a call spread. So when the market's ripping higher, there's usually a good chance that market skew or sort of market's expectation that's built into the option price is essentially telling you that there's all this hopium in the market, right? The market's going to rip another 25% overnight. And you're thinking, all right, well, this isn't really going to happen right now, but I do know that, you know, it's relatively a good time to be long. So call spreads tend to be more ideal in those situations because what you're doing is you're essentially selling an out of the money call and buying in sort of at the money or in the money call. And so what this does is these trades sort of offset each other in a directional risk, right? It limits the upside, but it limits the downside. And what you're doing is you're selling a product, the call option that you're selling will likely have more premium associated to it than the call option that you're buying. I'm using the word premium, not price, so just something to bear in mind. And what you're doing there and what you're expressing is that I think the market's going to keep going up, but I think currently in its form that people are a little too heated, right? And I think that the call spread or the calls, the out of the money calls, they've gotten a little too juiced, right? Everyone's buying out of the money calls, thinking they want to like 20x their money, and because of that, the price of those have gotten really high, and so that can become sort of the bias that you want to take. Another one could be, I alluded to on the call here, which was synthetic exposures. So if you buy a call and you sell a put at the same strike and same expiration, it has literally the same payoff as a Delta One market. So whether you own a perp or spot or a futures contract, it's essentially going to have the same payoff. And so it's possible that the funding on the perp can be significantly higher than the interest rate on the call option and on the put option. So essentially what I'm saying is that the cost to get leverage in the option market can be cheaper than the cost to get leverage in the perpetual market. So now this offers you multiple things. You can either choose to get long these synthetic options or these options that build a synthetic position. So that's an alternative. Or again, as I think one of the listeners mentioned about funding, right? You could say, oh, well, funding's super high on perps. I don't want to take a directional risk right now. So I'll own the synthetic exposure and I'll short the perp. I'll collect funding for the next 2-3 weeks. And then once I believe that the market's a little bit more in line and ready to go up, I can take off my perpetual hedge. And then I have my synthetic directional exposure again. Or you could close the synthetic directional exposure and just keep the perp. So you can switch in and out of markets, right? And this is something that people do actively with perps. Some people might bounce from exchange to exchange because the funding on one exchange is egregious, right? Maybe the market makers have some liquidity issues, and so funding's at 35, 40, 50, 75%, right? And another exchange that you've used is at 15 or 10%. And so you quickly bounce money over to the other exchange and you get long, and it's just cheaper to do it beyond that exchange. This is a similar thing that you can do through options as well on our exchange. So a lot of different ways to express directional exposure via options or a combination of options and perps. So hopefully that answered that question. I wasn't sure.
Yeah, I can give a small example too with straddles. If you expect a volatile event like the election, for example, or when Trump was starting the tariffs or announcing them on April 2nd, with options, with this straddle strategy pick, you can buy a call at a certain price, buy a put at a certain price, and you profit from the volatility because it's going to go either beyond that one or beyond the other one. It's easier. It's a lot easier than doing this with perps. It's a lot easier to actually be in profit and not just neutralize both positions.
Yeah, it can be. And so like in that scenario, obviously, when you're buying these straddles and strangles, you're looking for a directional move that surpasses a threshold of the cost of those options, right?
Yeah.
And so
you don't know the direction.
But you don't know the direction, right?
Yeah.
And that's actually a great point with, with the unpredictable nature of like the market right now and how just a single tweet or a single message all of a sudden sends the market up or down, 5%. It's a good time to also be exploring sort of those volatility-based strategies that you can do. Now, the reason why I didn't bring that up is because that's a little bit more of a volatility versus directional. I think you can view it as two different lenses, right? You want the price to surpass or go below a certain threshold. But ultimately what you are doing is you're betting on volatility, that you expect that this market is actually going to have some sort of surprise event that was not priced in. And then you're going to win because of that, right? And that's usually how you win on sort of those volatility trades, is that what the market is pricing in terms of volatility, you're saying that it's low, right? And when we mean by volatility, we're talking about implied volatility. So if you have an opinion that implied volatility should be 70 and currently it's 50, it's probably a good time to be buying straddles, right?
Mm-hmm. Yep.
Boom.
It's a lot
All right,
there.
our next one.
Yeah.
Yeah, that was a lot to take in. Tolga,
Yeah.
let's get into hedging options with perps, because for our perp traders who are tuning in and people who are going to gain interest because they hear, ooh, there's perps. Let's talk a bit about how perps are going to be introduced on Kyan, how they're going to function, because it's going to be a bit of a different experience in the beginning. They're not going to be able to, slide their leverage bar to 50x and come and buy,
Sure.
get an ETH 50x long. They're used as a tool for hedging your options out. So let's talk a bit
Yes.
about hedging combo trades, risk management.
Yeah, for sure. So perpetuals in our system, as Cozy mentioned, you're not going to have 100x leverage on a directional perp trade. That's not how our system works. In isolated margin systems and exchanges that are strictly related to directional perp trading, that's definitely something that they offer. There's a plethora of exchanges that offer that. I don't think us offering that is going to make us any different than all the options that you have that already do that. And again, as he said, because he said that's not the purpose of the perps in our system. Now you can get leverage. So in our system, if you just simply put, if you wanted to have a directional trade and you wanted to get as leverage as possible with perps, our system will most likely offer you somewhere between 5 to 8x leverage. So 5 to 8x leverage, I mean, again, just depending on your taste and appetite for risk, I mean, that's pretty high, even for like ETH and BTC, right? The likelihood of you even getting liquidated is relatively high, right? On a 5x or 8x trade. When you have 70 vol products, 5x trades are extremely high in terms of leverage. Now, where our system really flexes hard is when you use perps in conjunction with options. That's where leverage can get as high as 20 to 30x, right? And so one of the things that, again, it was a perfect question that one of the listeners asked was around like funding. I mentioned this idea of taking a synthetic long exposure in options and then shorting it with a perp. And so that would be an example of where you have a perp and options hedging each other. Now our system understands this and knows that the risk of this trade is not high, and so then you get rewarded by having more leverage to be able to do that trade. So now you start to get into the 20, 30, even 40x leverage style positions. Again, you're collecting funding, so when you're doing a 40x trade, the funding's funding isn't a large amount of money, but if you do it at 40x leverage, the return on investment is relatively attractive. So that's one of the major benefits that our system has. And so perps can be more useful to you, and you can get more leverage with perps with options, right? Another example would be, say, let's say I shorted a call option, and someone wanted to collect some premium, and all of a sudden they realize that there might be a chance that the market is likely to rip in the short term. And they wanted to cover some of the delta exposure, but they didn't want to close their short call position, right? And they wanted to continue to collect the premium. They think that it's going to expire out of the money still, even though the market's going to go up. And so what they might want to do is they might want to hedge that short call by longing perps, right? And this way you'll absorb some of that upward directional movement through the perp and make some money from that to offset the losses on the option, while still collecting the premium and time decay from the option. When you do that in our system, it's going to notice that you're actually hedging your short call. And so when it does that, it's basically actually like infinite leverage for that particular size that you want to trade. So if I was trying to delta hedge my trade all the way up to that delta hedge, our system will actually release collateral for you. So imagine a scenario where I'm short this call and I have about 100, I'm just going to make up a number. I have $100 locked up. Our system says you have to have $100 to own this short call. But if you get long a perpetual and delta hedge it, we will now require only $50 or $40 or $30 of capital. So what that perp actually did is it created, it freed up capital in the system for you to now use that money somewhere else even. And so that's an important thing to note, that isolated margin systems look at those two different trades as completely separate trades, and they reserve money for each one, right? So if I'm short this call, the system, the isolated margin system says, all right, I need $100 for this position. I want to go long this perp. Okay, well, you need $50 for that. So I need $150 to put on both positions. Where in portfolio margin, I started off with requiring $100 for that short call. But the moment I put on that long perpetual position, my margin requirement actually net went down to, like, say, a $40 or $50 amount. So that would be an example of where you can use perps and what exactly happens from a risk management standpoint. Your system understands what you're doing, and because of that, you get rewarded, and the position becomes less capital intensive for you. I'll take a quick breather.
Yeah, we only got 3 minutes left. We got any other questions?
That's what I was looking at right now, because I have the stream on here only shows some of them, but I have multi-stream going on. That's where I got the other ones from. No, nothing there yet.
Well, feel free to cut me off, but I
Nice.
do want to explain these images on the
Yeah,
right.
let's
Yeah, I was going to ask
Yeah.
about the UI.
Yeah. So
take me through the
these-
difference between this market limit and RFQ orders, and how those kind of work with building out these positions.
Sure. So like this tab that you see here, this is going to be like a sidebar. So if you're familiar with basic trade panels, this is going to be sort of our trade panel on the side of the options chains. So in the main screen, you'll see the options chains and the different options that you want to, you can pre-select from. You want to go back for a second? Yeah.
Yep.
And then when you click on one of those options, they pre-populate into the side panel, the trade panel in this particular instance. And so at the highest level of the trade panel, you can do a couple things. You can trade an option individually, you can trade a perp individually, or you can jump straight into combo trading. And so this page, or this side trade panel, is likely going to be in conjunction with the option chain only. But it allows you another entry point into doing individual trades, legging into individual trades, or expressing or wanting to do an atomic trade in itself, like an all or nothing type trade. So imagine you want to do an option trade. And so you have this pre-populated trade. In this case, it's BTC, right? You can express the trade in a couple ways, right? You can do it either a market order, you can do it through a limit order. These should be relatively common terms for people, or you can do it. You can request an RFQ. So we have a full backend system that's designed for RFQ to do for perps, individual options, combos, essentially everything across the board. RFQs are an optionality if you're looking to trade size, or if you feel like the market is wide for some reason, the market makers are being a little passive, you might want to request an RFQ, see if they can get a little bit more aggressive. Those would essentially be your three optionalities that you have in terms of executing your order. When you do an option trade, one of the nice things we have is this ability to actually even add perpetual futures to the trade itself. So imagine if I wanted to delta hedge my trades that I'm doing, you can express it through here and be able to do the delta hedge while you trade the option itself. Or if I wanted to do the option first and then I wanted to delta hedge at a later time, you can see the other screen. Very simply, you can just toggle over to the perp side and then enter in the perpetual futures size and price that you wanted to trade, and order type, and click trade, right? And it's the same thing. You have market order, you have limit order, and you have RFQ for perps as well. And so this you'll see on the active trading page, and this is probably the best ideal entry point for someone who wants to be legging into trades or wants to be doing individual trades. I would say maybe a little bit more high touch type of person, where they want to be actively picking and choosing like different options that they're getting in and out of. They sort of want to shop around on the options chain to kind of see where a particular strike looks interesting. Maybe there's like a kink in the volatility surface for some reason, and you want to sort of exploit a certain strike. You get to see that on the option chain and essentially build your position right on the right side.
Boom, boom, boom. I wish I could make this one pop out a bit. They're just highlighting. I thought maybe I'd get some sneak
The
peeks.
drop downs like actually worked.
Yep. I thought maybe I'd get a little sneak peek to people.
Now, yeah, this one's a cool page. Yeah.
Yeah, let's move on to the
Wanna go
actual to the UI here that people are going to see, and let's talk about hedging with perps. Let's first talk about what this is. We did a bit before, but now we have a visual to kind of go with what we talked about like 2 topics ago, which was strategy building. And here's kind of what that strategy builder will look like, as well as your positions that you are choosing for that.
Yeah, you have
there's so much
everything.
more to
This
this
is just
page,
more
so-
detailed, right? This is kind of like the full on page that gives you all the specs that you need to sort of make a decision on a combo trade. You have essentially the Greeks of the exposure that you're building, the ability to add more legs, the ability to customize the legs, the ability to add perps, to change different strikes. Essentially, you have everything at your exposure or exposal here, right? And yeah, I mean, this is essentially what will happen is right there too. There's the so interesting point here to bring up is when you do these combo trades, you can either interact with the order book, which is usually the preferred way to do most trades. Again, if you're looking to do larger size or there isn't an available market on the order book, then you could hop over to the RFQ side and see if there's any market makers that are willing to give you a quote for maybe the complex position or large size position that you have, and you're trying to look for a better price. You can explore it through there as well.
Now, while we have this page up and everyone's kind of soaking it all in, let's talk about this a little bit. So we have some different accounts here. We have a main account, active account, and then over here on their portfolio, we have IMR and MMR. What is IMR and MMR? What are these ratios? What do they mean to a user? Why are they important enough for us to put up here in the header?
Yeah, we want to touch on those. So IMM or IMR and MMR, we touched on that quite a bit on the portfolio margin presentation. But those are going to be your, there's going to be a common theme that you're going to see throughout the system. And essentially everything that you need to monitor your account health, your risk levels are through these IMR and MMR. Now, if you've used Deribit, these should be these are one-to-one with them, so there's nothing here that would be relatively new to you. If you are maybe a little bit newer to options and haven't really used portfolio margin before, this will be slightly a newer, a different version of how you have kind of seen margin numbers. Let's say from a perpetual only exchange, the margin numbers and the way they express leverage, things like that, are a little different than how a portfolio margin system will do it. Essentially, IMR is the number that allows you. This is essentially how much risk appetite or risk availability do you have in your portfolio to be able to add new positions, to how much capital your account currently has locked up in terms of, all right, well, if I wanted to add more risk, how much availability do I have? The IMR and the IM number itself kind of show you that. The IMR is essentially a ratio of your initial margin requirement, so the capital needed to initialize a trade, divided by the equity number, which is sort of your account balance. And so whenever this ratio, as long as this ratio is under 100%, you have the ability to add risk to your portfolio. And so I'm being very specific here. I'm saying add risk, not add positions, because certain positions can reduce risk, right? And so something to keep in mind, our system always looks at trades based on risk, not based on just the fact that you're putting on a position. MMR is sort of your liquidation number, right? That's the one where you do not want to cross 100% at any point in time. If you do cross over 100%, your account will then go into liquidation. So that is sort of your like max threshold, right, that your account can take until your positions essentially get forced closed. And so when you do these combo trades on the screen, you'll also be able to see the pre and post analysis of your portfolio. So you don't actually see it on the screen at the moment, but when you do put in the trades, the system will tell you what your IMR was before, if you didn't do the trade, and what it would be after you do the trade. And so this gives you also a good sense of like, when I do this trade, how much of my capital is this going to tie up, right? And so there's a lot of good information that you're going to see between the IMR and the MMR. Our system is going to do a great job of constantly telling you when you have an action that you want to do, it's always going to tell you the before and after number, right? And essentially that's the key to tell you, am I adding risk? Am I reducing risk? How much capital do I have to keep increasing the risk if I wanted to increase it? And as you toggle the number, the pre and post trade numbers, or the post trade number, will change, and so it will go up. And essentially you could sort of back into what that max leverage, if you wanted to put on max leverage of a position, you could figure that out easily by just toggling the size and getting up to the max allowable leverage that the system will give you. But there's a lot of good stuff on I think the portfolio margin call about IMR and MMR. I think we break those down a little bit further. We talk about them a little bit slower, and we kind of go through them more methodically. So definitely check out that presentation if you're not familiar with those two terms.
Yep.
And that brings us to the end. That was long, much longer than I initially anticipated, but in a good way. We got a lot of information out there.
Thank you very much, Tolga.
Tolga, yeah,
Yeah,
I really
start
appreciate
talking.
No, it's
I
not a
hope that
bad
wasn't
thing.
too
It's a good
painful
thing.
for all of you guys. I just start like going off. And,
No, it's good.
Yeah.
It's a good overview.
This was our first official live stream directly to YouTube on the Premia account.
Nice.
No, that's all sorted out.
Nice.
So I'm gonna get the last one up there as well, so that way everyone can we'll create a playlist and just put all of these Kyan specific overviews and live streams in that, so it's easy to find. Got a bunch of new comments coming in. We'll wait till it loads, or maybe it was catching up. All right, I guess it was just bugging out. Talk Studio is multi-stream, likes to tell me there's lots of notifications for stuff, but then nothing. So I would like to thank you all of our community members, our viewers, our future users. You can follow at Premia Finance for now for updates, our YouTube channel, join our Discord, discord.gg/Premia. And we will see you back in 2 weeks. We're doing this again in 2 weeks, I think.
I think a month.
Nice.
Well, actually, it depends on some things. We can schedule it for 2 weeks.
And don't forget, go to Kyan.blue, subscribe to the newsletter for updates on the beta.
That's the number one source to get information on what's going on, timelines, when launch, all the good stuff.
Yep.
Yeah, we got
Kyan.
Black Shoals next week too, right?
Yep.
Have a call with them. That should be a fun one.
Mm-hmm.
Yeah, a lot going on.
Cool. We'll see you back next week for Block Shoals. Check out
Thanks, everyone.
Kyan.blue. Thank you for joining.